What's up, everyone? Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And it's my goal on this show each week to help you discover more when it comes to your finances and your investments. So I want to talk about the psychology of money today. Look, I'm not a psychologist, nor do I claim to be, but I'm a researcher and an experienced advisor of nearly 20 years. And when it comes to my profession, and we here at One Capital Management are serious about what we do and how we serve our clients. And we've gleaned a lot from many, many years of countless hours and thousands of meetings and with thousands of clients we get to serve across this great country of ours. There's a lot to be said about the emotional and the psyche when it comes to our relationship to money. And a big part of that is looking into the behaviors and thought processes and patterns of our clients and really of you watching or listening right now. So before we get started on this week's episode, be sure to smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. There's a book that I wanted to reference and then I love, and in fact, I have it right back there. The book's called The Psychology of Money. And there was an interview with the author who actually revealed some very interesting insights onto how to build and maintain wealth. So I'm going to tie in the psychology of money, the emotions that we've been feeling this year with volatility, with how to build wealth still and also keep it. Because a part of the keeping it has to do with, hey, Brad, I'm 50 years old now and I'm watching this and this volatility is freaking me out. I'm losing all that I've gained. Because in volatile times like this, we have to remember these things. So together with the items I want to bring up with this interview, I saw as well, that was done again by the author of The Psychology of Money. And as an advisor and as a podcast host, as a YouTube host, as a radio host, I regularly engage with a lot of, I guess you'd call them money experts. I think for everyone listening right now, in my world daily, that's what we're involved with. And I've interviewed everyone around the sun, from hedge fund managers to CEOs of companies, clients, and we get to talk a lot about things. And I've gained incredible insights from all of these conversations. Is why I want to do this show and share that with everybody. And I want to share simply one thing to say is this. This interview that was actually on the Stay Wealthy Retirement Show, it taught me that all financial education in the world, and I've always kind of known this at my core, but all financial education in the world doesn't matter if your actions don't align. All education, by the way, not just financial education, okay? If discipline isn't involved or actions don't align, it doesn't matter. I want to say that again. All the financial education in the world that you might have or want to obtain doesn't matter if your actions don't align with that knowledge or education. And the conversation I'm referencing here is again with Morgan Housel. He's the author of The Psychology of Money. And in this book, he aims to explain why how we act matters more than what we know. And listening to his words and reading this book, I've read it a couple times, I came to the realization that what he says about the psychology of money is absolutely true. The psychology of money is actually a very simple principle. When there are people out there in the world who have no financial training, no financial education, no experience with money, again, this is from Housel, yet they manage to do quite well. Why? Many, in fact, manage to morph into what we now know as a term, the millionaire next door. And Housel, the author of Psychology of Money, also says the opposite is true. I mean, there are Harvard MBAs and partners at places like Goldman Sachs who fail during the best financial markets and go bankrupt all the time. And you may think, well, why is that? How can that be? And I want to share that story real quickly and take a pause for a second, that just because you may not be a Harvard MBA or just because you don't work for Goldman Sachs or some investment bank doesn't mean you can't be successful with your money. I've shared this with the thousands of clients in 19 years of doing this, that discipline and discernment, the two Ds I always bring up, matter more than the knowledge of some price to earnings multiple or some ratio that you might bring up. And again, Housel, he insists that this is where the psychology of money comes into play. And I agree. What matters with finances and investing is how you behave. It's not what you know. I want to share that again. Investing, the true successful, matters more in how you behave, not in what you know. Which is why I always believe that having an advisor, I always get back to that, I understand this, but having an advisor or anyone in your life that has a skill set that you don't have or you don't, possess or want to have, makes sense to have that person in your life. It just logically makes sense to me. Proverbs, the book of Proverbs and the Bible, Proverbs 15:22 talks about this. It says, those who are successful have many advisors. And let me ask a few questions here to give you an example and frame this up. Can you control your relationship with greed and fear? If not, then it doesn't really matter how many hours you spend studying finance at Yale, right? I mean, without a handle on your emotions, which is something I talk about heavily here in investing and as an advisor, you might be the type of person who sells all their investments on maybe March 16th, 2020, when the Dow Jones Industrial fell a record 2,997 points that day. And sometimes the most disciplined investors may have even invested more or dollar cost average during the market's darkest days. But I thought I want to kind of go back up to the top part here and talk about the psychology, the rational, the logical, and then the connection point between that and our hearts. And really, let's call it our second brain, our stomachs, and our emotions, what my kids call their tum-tum. Right now is a great time to talk about it. That's why I want to dedicate this week's show to this. The emotions kind of run check. We get kind of wild on our emotions. Like, when you're a kid and your parents say, follow your passion. And I've always said, and I've spoken on this before at dinner events and on my radio show, I don't know that that's the word we should be using. Because if you look up passion in the dictionary, it's an emotion. When's the last time you really want to make sound, especially financial decisions, on your emotions? You want to find purpose. So I want to change the word from passion to purpose. Follow your purpose. And I think you need to be aligned. You need to pray on those kind of things. Find that purpose for your life. And when it comes to your money, again, attaching a goal and working towards that goal matters. It's the psychology of the discipline that keeps it going. And the knowledge that we talk about through the years of our clients, of us working together, we have a plan in place and we partnered with them to do that. And we see that. I think it's really big because there's a big kudos I want to give to our clients. I have other investment advisor friends who I know and colleagues who are on the phone 9 hours a day because basically they're handling client emotional calls. And they're kind of almost lamenting in a way. And I'm like, your job as an advisor is to make sure you steward them in the right direction and they trust the plan that you guys are on. And so I look at that and say, we're doing something right. And those that are following this are doing that too. And that's what I want to share. Why having a plan matters more than ever. Again, I know you're probably rolling your eyes when I say this if you watch the show every week, but it's interesting to note you can be the best stock picker in the world. And again, Housel said this, but here's this quote. If you lose your head, none of it matters. So the lesson around why having a plan matters is to control and manage the emotions every day, every minute, every hour. We have emotional stuff that sets us off, good and bad, that we can react to. I mean, when this subject comes up, I find that so many knowledgeable and informed investors or people out there in the world are rightfully perplexed by how the stock market has behaved. I mean, you hear these technical analysis junkies out there talking about, support level at this number, and it's all, to my world, technical jargon. The reality is the market is made up of you and I. So consumer sentiment nowadays, to their technical numbers, is a large part of that because we have emotions going into it. If the market's made up of human beings and human beings carry emotions, guess what? It's an emotional market. But it's also the companies and the sectors and the industries that make up the market that we get to invest in, that we are investing in. And on the equity side, when there's growth and value, there's value to be made. And the fixed income side, bonds, whether that's government bonds or corporate bonds or municipalities, it all works together. And how we interact with those and how we build the portfolio around that matters. It matters for the plan and ultimately for the success of your investing life, of your retirement life, whatever it is you're trying to attach a goal to when it comes to your money. Now, Morgan Housel actually brought this up too in this interview I'm mentioning here. And this is where you have to realize that the stock market, and I want to share this because I think it needs to be reminded for people. The stock market is not the economy. I want to share that again. The stock market and the economy are not the same thing. Here's an example. The growth of technology has made the disconnect between small business and major tech companies wider than ever. And we need to make sure that we're filtering what we're reading and intaking, what our eyes are seeing, what our brain is rationalizing and interpreting, and ultimately what our heart is feeling. And we need to make sure we're operating not from our heart, which I know sounds a little crazy. We want to operate from a logical and rational perspective when it comes to your money. Amassing wealth, you define wealth for yourself, over your career takes hard work. It takes optimism or the glass half full mentality of going to work, seeing things for what they are, but also knowing that God has a plan greater than what we're dealing with right here, right now. And having a skill and a trade in what you're doing, which all of you watching or listening hopefully have, but understanding when you get to that retirement. And by the way, I've said this before, retirement can be becoming financially free. It doesn't mean it to be 65. It could be in your 30s or 40s if you start a business or you living off what you want. That's great. But once you get there, once you stop working, it doesn't mean your purpose stops. Your purpose for life is much more than just being, an engineer or a doctor or a business owner or whatever it is. It's more than that. And it's also taking the idea of working with some to have, an eyebrow raising to some of the things you should or should not be investing in. That's the old adage of you're supposed to get, more conservative or aggressive depending on your age. And it's really, neither one is right or wrong. It's just what works for you and your family and as you build that plan with your advisor. Now, ultimately, that's what Housel himself sometimes goes against the grain when it comes to traditional financial advice, which I kind of like. I definitely think outside the box here for our clients. This award-winning financial writer, Housel, I'm mentioning, he actually paid off his mortgage recently. He mentioned this, even though it made this is his words, no mathematical sense. I mean, you can get a 30-year loan at his rate where he was paying at 2.9. That is not the case right now. But he felt confident that the stock market will return more than that over time. But to him, he says, just not trying to score the best investment returns, but he's also trying to sleep at night. And so when you think about these, when I talk about emotions and I talk about rate of returns and volatility, they need to go hand in hand, but the rational logical should be the one driving the ship, not the emotions. Hey, I hope you enjoyed that show today. If you did, make sure to subscribe to our show so you don't miss a single episode. And always remember to make your money matter.